Hello everyone and welcome to the Inside ETFs weekly webinar. My name is Matt Hogan and I'm the CEO here at Inside ETFs and your host for this webinar series. In today's show, is it safe to buy from ETF startups? Today's ETF industry is dominated by the big three firms. Between them, BlackRock, Vanguard, and State Street control 82% of all ETF assets in the U.S. And big funds, that is to say funds with more than $250 million in AUM, account for 98% of all assets outstanding. But what about the other 84 issuers and the other 1,500 plus funds? There are great funds buried in that list, but can you buy them? Can you trade on them? And can you count on them to be there in the long haul? In today's show, we're going to talk to four true experts deeply entrenched in the entrepreneurial side of the ETF industry. Phil Bach is the founder and CEO of ACSI Funds and Exponential ETFs, a startup that's bringing unique alpha-seeking ETFs to market, including the American Customer Satisfaction Core Alpha ETF, which has $41 million in assets and leverages proprietary customer satisfaction data to pick stocks. Will Rhind is the founder and CEO of Granite Shares, a VC-backed startup trying to make a big name in the ETF space, in part by offering ultra-low-cost exposure to critical asset categories. Will also played a key role in the success of ETF Securities, one of the most successful ETF startups in history, so he has a unique perspective on the challenges and opportunities that this approach offers. Joining them is Dave Nottig. Dave's the CEO of ETF.com. He's seen ETF startups succeed and some fail, and he's talked to thousands of advisors about how they pick and choose ETFs. He helped develop the first ETF-specific rating system, and he spent hours debating how to handle these new ETFs. So he brings unique expertise. Finally, Koen van Zevenhoven is co-managing director and head of trading for Flow Traders. So Koen is right there helping to provide liquidity into ETFs that may not trade a lot on the surface, but have underlying liquidity with them. In today's webinar, we're going to ask the panel, how do I know if an ETF startup is going to make it? Is it safe to buy their funds? Should advisors bet on these funds? And how do you successfully trade these ETFs? But before we get to that roundtable discussion, we're going to bring in Koen van Zevenhoven of Flow Traders for our trademark 5 questions in 5 minutes session. Flow Traders is one of the leading liquidity providers in the ETF space, helping investors access deep liquidity in seemingly small ETFs. And they're also a supporter of today's webinar. So I want to hear Koen's insights in how to trade both smaller new ETFs as well as things like fixed income ETFs where the liquidity challenges are simple and transparent. So Koen, welcome to the show.
Hi, Matt.
It's great to have you. So we're going to start the timer now. We have exactly 5 minutes to answer these 5 questions, and I'll be keeping track here. But let's start with number 1. Who exactly is Flow Traders anyway?
Matt, Flow Traders is a global ETF provider. We were founded in Amsterdam in 2004. Since then, we also expanded to New York and Singapore, and most recently Hong Kong. We provide liquidity across all exchanges for 24 hours a day, making prices on all exchanges. And since recently, we also made a big push off exchange for institutional counterparties.
All right, we're going to get into that a little bit. But a lot of what we're talking about today is new ETFs, some of which come to market, that they don't trade a lot initially. So how do you make markets for clients in ETFs which have limited on-screen liquidity?
In theory, that's not really a problem. As a liquidity provider, we always have access to creation redemption, the primary market of the products. So as we are specialized in pricing all different kinds of underlying instruments, the liquidity in the ETF itself is not of key importance as long as we can hedge ourselves in the underlying instruments.
So is that true across all new ETFs that come to market, or are there some that are more difficult than others?
It does not really matter. If ETF doesn't trade a lot, but we can still, with our pricing models, like hedge off our exposure in the underlying instrument, for us it's not very important how high the volume is on exchange.
Yeah, okay, and that's true for traders of all sizes. Do you deal with advisors who may be trading, 5 or 10,000 shares, or do people have to be trading 50 or 100,000 shares to come to you?
All sizes should be okay. Like if the size is large, we can relatively easily create and redeem. If the size is small, we can relatively easily put it in our model and keep it on our book and provide liquidity. So for us, there's no real difference in size.
All right, 2 questions, 2 minutes. Let's go on to number 3. Now, you have come into the market as sort of a challenger brand in the U.S., and this could be just me. I think of you a little bit as coming from an equity background, but you've been winning some market share in the fixed income space. That's a challenging market, so I guess how are you competing in that space?
Yeah, that's correct. Primarily, we have been an equity-focused house. So the equity business is, of course, a highly technical business. So us as being like a technical, tech-based firm allows us to have an edge in the fixed income space because of the tools and experience we have managing large data to come to theoretical prices. We notice we have the way we look at things gives us an edge in a business that has been traditionally more manual.
How does that work for something like corporates where there isn't a price for corporates, right? When you say equities is more, technology driven, it's usually because you can estimate the price really accurately. So what do you do in the high yield space to square that circle?
In the grand scheme, the fixed income space is not as much different in determining what the price is. The access to where these products trade is still visible. I think it's more the trading of the underlying product which is still a manual process versus with equities, which is more trading on exchange. But for us, in providing liquidity in the ETF, we just need to know what the theoretical value of the product is based on the prices and not necessarily manually trade them all.
All right, let's go to this question. This has been coming up, Dave and I think everyone in the ETF industry hears this all over. Is there a risk of fixed income ETFs blowing up the world of a liquidity meltdown in the high yield space or the emerging market space?
Well, we look at ETFs as a vehicle to access liquidity in various underlying instruments. So in the case of fixed income, we believe that ETFs provide access to a wider range of end investors into the fixed income space, which in the end just leads to better price discovery and efficient markets, we believe.
So no risk that you're seeing right now?
Yeah, we look at ETF as a vehicle rather than a cause of risk.
Right. All right, we have about 45 seconds left for this question. A lot more trading, particularly in these less liquid ETFs or fixed income ETFs, is coming in over RFQ instead of you having a one-on-one relationship with an advisor. So I guess my question is the rise of RFQs good, bad, or indifferent for end investors?
We believe it's a very good development because in the end it leads to increased transparency, efficiency, and competitiveness in the market, which is also the characteristics of ETFs in the first place, which is what we believe is in the end good for everyone. It's for everybody easy, quick, and cheap to access ETFs, which is exactly what we want as a liquidity provider because it will make ETFs a more popular product.
I couldn't agree more. All right, well, thanks so much. Koen, maybe you can stick around for our roundtable discussion. Do want to bring in the rest of the crew here now that we've covered liquidity a little bit. I'm going to start with you, Phil, with ACSI. Our goal here is really to ask the sort of uncomfortable questions. So, if I'm an advisor and I'm thinking about one of your ETFs, aside from the liquidity issues we just talked about, how can I know that ACSI and exponential ETFs will be around in a few years? Do you get those questions from advisors?
We get them sometimes, and I think it's a fair concern, and quite frankly, I wish we'd get them more because if it's a concern that's holding somebody back from potentially an investment that is beneficial for them and their clients, then I wish they would ask the question. The cost The cost to launching an ETF issuer, not only the intellectual capital, but the cost to do it is pretty substantial. And it stands to reason that anyone who's in this position has planned for several years out. But it's still a very fair question. In our case, the ACSI has been around for over 23 years. We've managed a hedge fund for about a little over 8 years. And our sister company is the CFI Group, which does consulting globally. So, our plans for the long term are pretty solid and not really dependent on, striking lightning in a bottle. But I think it's a very good question for advisors to ask and to understand so they can go build a relationship with the issuers early and get in the early stages of innovation.
And one of the questions I always get from the media, Phil, is what assets do these firms need to be successful? So, what are the economics of running something like ACSI funds? What assets do you need to be successful?
There's a lot of variability between asset classes and depending on the product structure and the product types and how you put it together. The typical rule of thumb is about 25 to 45 million in assets for a fund to be self-sufficient operationally, but that doesn't cover distribution, it doesn't cover overhead and all the general business costs, which can be very substantial. So, then it becomes about, how well you manage a business. We're managing our business for about 1/10 of what some of our larger name competitors are. But there's, it really can depend very wildly depending on, what services you leverage and outsource and what you build on your own.
All right. And I guess the big question, if I'm an advisor, there's an old saying in technology, no one ever got fired for buying IBM. I think in the advisor space, no one's ever been fired for buying a Vanguard ETF. So why should I take the risk with one of your funds as opposed to going with, just a blue chip, VT style broad-based cheap exposure?
What we're seeing right now from the clients who are investing with us are really two factors. One is they're looking to differentiate their business from what's available from the robo-advisors. It's going to be very, very hard and increasingly hard for advisors to compete against Wealthfront and Betterment. They've got incredible technology. They've got great systems. But they've got very vanilla asset allocation models, and we see advisors that are looking for differentiation. And when I say differentiation, I don't just mean in terms of the names of the issuers, but I also mean in terms of the alpha, in terms of where the performance is coming from, what the correlation is of the different drivers of those returns are. If you're just going cap weighted, or if you want to diversify that among different factors, or in our case, using proprietary data to mine for factors. The other thing that we're seeing is there's a relatability issue, and people are looking to be more connected to their portfolios and to the products that they invest in. When we talk about customer satisfaction, everyone has a story that they can talk to where they either did more business or stopped doing business with a company because of a customer satisfaction issue. And when we distill that down and we talk about how we use our proprietary econometric model to measure it, and how we use our portfolio management system to implement it into the index, which the ETF tracks, we find that resonates. But everyone's got a different story, and ultimately, I think advisors, Vanguard fund is certainly appropriate for certain cases and certain advisors, but there's a whole menu of other options out there, and I think differentiation is going to increasingly become an issue as technology and the robo-advisors become a bigger and bigger part of the advisory business.
Yeah, I want to talk about Vanguard in particular in the robo-advisor space in a bit, but I do want to bring Will in from Granite Shares. One thing I noticed, Will, when I Google Granite Shares, the little undertext says a fully funded ETF company. You did just raise money. I guess, sort of what's the pathway to success for Granite Shares? How much money were you raising? How are you thinking about the long-term sustainability of the business as you go from zero assets to a significant share?
Yeah, sure. Thanks, Matt. It's a good question. So I think in terms of why raise money at this particular stage, there are a couple of good reasons. I think the game or the industry has changed over the last few years. Certainly, I think the barriers to entry have gotten higher, and the barriers to success certainly have gotten higher in the business. And so I think that raising capital up front is important really for two things. One, because as Phil pointed out, I mean, this is not like throwing up a website. This is a capital-intensive business, and we live in one of the most regulated environments in the world. and all of that costs money. And so it's important, when you're building a fund company that you have capital to do that. I think the second point is a little bit to one of your earlier questions, Matt, which was about confidence and how do investors have confidence in a new company in the market, and how do they feel comfortable with investing in the products and services of that new company in a market where at the end of the day we're fiduciaries, we're managing money for people, and that's a trust business. And for me, certainly, having a kind of institutional backer was very important in terms of establishing that trust and getting people comfortable with the fact that this is different from maybe a one product shop or something, that this is a real business with real backing.
Right. Yeah, no, and that comes across. I mean, the very name Granite Shares sort of speaks of that stability. But what do you say to advisors who come to you and just ask, why should I buy your products? What if you don't survive? Like, what do you tell people? You must get those questions.
Yeah, I mean, like Phil says, that's not an uncommon question, and I think I'd sort of answer that in two ways. I mean, first of all, the why should I buy is the easy one. So that speaks to the fund itself and the value proposition of the fund. And for us, we've got the lowest management fees in the industry for gold ETFs and for broad commodities. And with the broad commodity ETFs, we're innovating by providing a better structure to investors, so a 40 Act fund with no K1. So there's a real value there to investors, and that's kind of clearly something that we've thought a lot about in terms of establishing the business. And then you've got, what Kuhn talked to the beginning, which was tracking error of the funds and spreads, liquidity. So all that's around the why buy the fund. I think in terms of the survivorship or the company, again, that comes down to, do you have institutional backing? Is the business capitalized? And, for investors, again, investors aren't investing in Granite Shares, the company. They're not investing in an operating business. They're investing in underlying funds. And, the fund business is a very highly regulated business. I mean, people don't lose money if a fund closes down. That's one of the only occasions in the market where you actually get redeemed from a fund at NAV without a commission. And so I think in terms of the actual fund space, there's a kind of unnecessary taboo about funds and about survivorship of funds. But certainly in terms of the company, that's really the main reason as to why we capitalized the business in the way that we did.
That makes sense. Dave, you hear these pitches all the time. You hear from Granite Shares. You hear from ACSI. You also speak to advisors. I guess from your perspective, what's your advice to advisors about considering new ETF companies?
Yeah, I think I would approach the new ETF question the same way, frankly, you approach the ETF question. I think fundamentally most advisors are and should be focused primarily on exposure, right? Are they getting the exposure that they particularly want, and are they getting that in a sort of an efficient, easy to understand, easy to access package? I think the newness of the issuer, frankly, I see it coming up less and less when I talk to advisors about their ETF selection process. The newness of a specific fund, sure. If a fund's just launched this week and it doesn't have any particular track record, maybe it's a new smart beta fund, it's obviously completely normal for investors of any stripe to be taking that new fund with a grain of salt and doing a little bit of research, seeing if it gets some traction. But I think it's worth pointing out that when you think about fund closures happen all over the map, and frankly, they're just as likely to happen from a giant $100 billion fund family as they are from somebody who's got 3 or 4 funds. So there's really no direct connection there. So I would focus at the focus on the exposure you're getting. And I think one of the ironies is if you look at the launches that are coming from some of the smaller players, like Will, like Phil here, in many cases they're providing not just a unique exposure you might not have gotten somewhere else, but frankly a really competitive one. I mean, you look at some of the funds that have been launched, by these folks in the last couple of years, they're often sort of, I would say, better exposure, often at cheaper prices than you might be able to get from some of the giants.
When would you get concerned, I guess, Dave? Like when would you sidestep a fund, a zombie product? Do you worry about any of those things, or is it just always search out the best exposure and assume it'll be there?
Well, you have to ask yourself to some extent what the downsides are. I mean, as Will, I think, correctly points out, in a traditional fund, the worst case scenario here is you put your money in a fund that, has its sort of initial $5 million in seed and doesn't trade particularly well, and then that issuer decides to close that fund. Truly, the worst case scenario is you end up getting your money back at NAV. I think that's a truism. Now, are there corners of the market where investors should be a little careful? Exchange traded notes, which aren't actually funds. You have to worry about the bank behind an ETN going bankrupt. There can be little pockets like that where you should do a little bit of extra homework. But you can't just look purely at the trading volume or the initial seed money and decide, this fund isn't for me. Now, that being said, if you're trying to trade something that is fairly new and is fairly speculative, not a long-term exposure, but something where you're trying to get access to a theme that you think is going to be relevant for a week or a month, then it's legitimate to say, what's the trading volume going to look like? Because now you're putting yourself in the position of a short-term investor. On-screen volume is going to matter in that case.
Right. Let me bring in Kuhn here for a second. Yeah, go ahead, Will.
Yeah, no, I was just going to say that it kind of reminds me of, back in the day, I'm one of the kind of original folks from the iShares team, and been doing this a long time. And I remember when, 16 years ago, closing a fund was really taboo. And I remember we closed a family of funds at iShares, and the only concern or pushback we had from investors was nothing to do with the things that we're talking about. It was the people that had actually chosen that fund and put their money in it because they wanted that exposure. And then when the fund closed, they were mad because then they had to go and find something else that wasn't exactly what they wanted. It was nothing to do with losing money or any of these other things that we're sort of talking about, which are much more arbitrary. It was just a simple fact of someone had selected that fund because that was the fund that they wanted, and they were mad when it closed down and had to go and find something else.
Right, which makes sense.
Yeah, and Will's exactly correct there because, if you take a look at the closures that have happened in 2017 year to date, we've got 110. 28% of them were from either the top tier issuers, the big three, or from a bank. A very disproportional amount were leveraged and inverse, 25%. Only 17% of them were from startups. And if you go back to 2016, the number is even more so. Out of 128 closures in 2016, only 10 of them were from, what we would consider a startup issuer, whereas 45% came from the big three or the banks. So, it's not an issue that's exclusive to a startup or a smaller ETF issuer.
Yes, that all makes sense. Now, good. Let me bring you in. I think those are good points. If someone does come into the market and wants to trade one of these funds, how should they approach it? If they want to trade, ACSI or Will's ultra low cost commodity product, what steps should they take, I guess?
We would first have a discussion. Well, there will be the institutional side for us with their coverage person. And see what they're exactly trying to achieve, and depending on what the product is, we'll do it in the way that is the most efficient with the best outcome.
And do you guys must get approached by a billion people with ETF ideas asking you for seed capital, asking you to make markets in those products? How do you decide which ones are worthwhile and which ones will never make it?
We don't seed products. We make markets and go out on screen. So for us, this is not really an issue.
And you'll tackle any product that comes that is live and trading.
Any product that is being listed gets on our radar, and we will make markets in it if there's interest.
Right. I guess a couple closing questions to the round table here. You know, Dave, I'll start with you. We hear criticisms all the time. There are too many ETFs. You say there are good ETFs coming to market. What do you say to that? Are there too many ETFs? How do people make sense of 200 multi-factor ETFs coming to market? How do people keep track of all these things?
Well, so, it's definitely the case that, if somebody wants to come out with another 200 plain vanilla funds, we probably don't need those right now. But even saying that, there's still opportunity to compete. In many cases, the entrenched player in a particular space is frankly radically overcharging, or it's not providing precisely the exposure people want. So we do see firms. It's hard to think of a firm like Schwab as an upstart, but they weren't in the business a few years ago, and they've carved out a niche by competing purely on cost, right? So there is, I think, still room there. I think funds that are coming out that are particularly complex just require a different level of analysis, and I think that can catch some investors up. If you're an ETF investor who is used to selecting really plain vanilla beta exposures because that's where you're comfortable as an investor, then sure, looking at the dizzying array of smart beta and multi-factor products that have come to market might be a bit confusing. I would pity those poor people if they go and look over at the mutual fund side of the house, though, because they've got another 8,000 funds they're going to have to deal with over there. So I think what we're seeing really is just the maturation of the ETF industry, and we're going to see, I think, a similar level of product proliferation that we've seen any time a structure gets a lot of traction. We're going to see active management. We're going to see a lot of quant active management. We're going to see more and more ways to skin the cat, and I think what you'll see is, as has happened in the traditional mutual fund industry, exposures that stand the test of time, that provide unique opportunities for investors to capture specific markets, exposures that do that in an efficient, understandable package are going to be the ones that tend to gather the most assets.
All right, closing question to both Phil and Will. We'll start with you, Phil. 3 years from now, what does your company look like? How many products does it have on the market? What is it focused on? What does it look like?
We don't have an asset target, and we want to make sure that we're listening to our clients, to our customers, to the advisors that work with us, and that we're providing tools that help them work with their clients. So we're providing tools for the advisors that are going to resonate, that have stories that will resonate, or that will provide performance that they're missing or they need to complete their portfolio. So, look, we're going to do as many or as few products as makes sense for our clients, and which speaks to what Dave said. I don't see people picketing outside Baskin-Robbins that there are too many flavors, right? I mean, the more flavors, if you don't want to buy them, the more options, the more people have. But I think a lot of it stems from the idea that ETFs are synonymous with broad indexes, and that was the case several years ago, but that's not the case anymore. People have realized that the ETF vehicle, the mousetrap, is simply more efficient than the other vehicles that are out there. So strategies that historically would have been hedge funds or mutual funds are going to continue to come out in the ETF space.
Great. Will, same question to you. 3 years from now, where is Granite Shares?
I think, again, similar to Phil, there's no hard and fast kind of numbers involved, but suffice to say, I think we'd like to be a kind of household name in the industry and create, our sort of tribe of investors within the space. And I think, what we're trying to do is really differentiate and disrupt the traditional kind of status quo that exists today, and bring something different and try and bring back kind of excitement in investing. And in the same way, I think, you brought up, Matt, that no one gets fired for buying a Vanguard ETF. Well, right now, we do something completely different than they do. So, in terms of providing new products or things that are slightly different, I think, we as a new and innovative business, have the opportunity to really react and change with the market. Product development, as a kind of general rule of thumb, typically is designed for the market environment of today. People want to develop products that sell today, not 5 years from now. And so this environment that we're living in, one of low interest rates, one of low volatility, and elevated stock and bond markets, that's the environment of today. But that's not necessarily going to be the environment of next year or 5 years or 10 years from now. And there are going to be big changes in the market. The market changes all the time. And it's companies, I think, like Phil's company, like my company, that can adapt to these changes and are kind of well-positioned for the next kind of generation of growth within this business.
Thank you very much. All right, well, that brings us up to the top of the half hour. I want to thank my panelists, Phil Bach of ACSI Funds and Exponential ETFs, Dave Nottig, CEO at ETF.com, William Rind, founder and CEO of Granite Shares, and Koen van Zevenhoven, co-managing director and head of trading for Flow Traders, for joining me on today's webinar. Thanks everyone in the audience for joining as well. We'll be back again next week with the Inside ETFs weekly webinar. Hope you guys have a great rest of your day, and good luck trading these great ETFs. Talk to you all soon.